Before we begin, please note that I am not a licensed financial advisor, and the information provided in this video is for educational purposes only. This presentation is not intended as financial, legal, or tax advice. You should always consult with a qualified professional before making any decisions regarding your personal finances. He was 34 years old, a software engineer, just had his second kid. He was healthy, ran a 5K every other weekend, and felt completely invincible. Life insurance? That was for his parents. That was something you worried about when you got old and gray. Besides, he had a small policy through his job and he figured, I'm covered. Then, during a routine physical, his doctor found something. A heart arrhythmia. It wasn't life-threatening, but it was a pre-existing condition. Suddenly, the cost of getting his own private life insurance policy skyrocketed. A few years later, he was part of a mass layoff. And that life insurance he had through his job? It vanished the day he lost his key card. In the span of a few years, he went from a healthy, low-risk guy who could have gotten a massive policy for the price of a few cups of coffee a month, to a husband and father with a new health condition, no job, and zero life insurance to protect his family. This story is real, and it happens every single day in America. It happens because of a series of dangerous myths we've been told. Myths that sound logical but can lead to absolute financial ruin for the people you love most. This isn't just another boring video about financial products. This is about protecting your family's future from the unexpected. This is about financial self-defense. Over the next few minutes, we are going to systematically dismantle the 5 biggest lies about life insurance. By the time we're done, you will have a crystal clear understanding of what's real, what's a scam, and how to build a bulletproof wall of protection around your family's future, without breaking the bank. Let's start with the biggest, most pervasive myth of them all. Myth number 1. I'm young and healthy, so I don't need life insurance yet. This is not just wrong, it is financially backward. Believing this myth is like seeing a once-in-a-lifetime sale on something you know you'll need for the rest of your life, and deciding to walk away to come back and buy it later at full price. Or even worse, when it's no longer for sale at all. Your health and your age are your 2 greatest assets when it comes to life insurance. They are the 2 factors that determine your risk, and in the world of insurance, low risk means low cost. When you are a healthy 25, 30, or even 35-year-old, you can lock in a premium, a monthly payment that is shockingly low. We're talking about securing $500,000 or even $1 million death benefit for your family for the cost of your Netflix and Spotify subscriptions combined. And here's the magic key. With a term policy, you can lock that exact rate in for 20 or 30 years. That means the rate you get as a healthy 30-year-old is the same rate you'll be paying as a 45 or 50-year-old. You are essentially time-traveling back to your healthiest, youngest self every month to pay your bill. Waiting is the worst financial gamble you can take. A healthy 30-year-old male might get a $500,000, 20-year term policy for around $30 a month. If that same man waits until he's 40, assuming he's still in perfect health, that exact same policy could now cost $60 or $70 a month. Wait until 50, and it could be well over $150. Over the life of the policy, waiting a decade could cost you thousands and thousands of dollars for the identical product. But that assumes you stay in perfect health. And that's the second, more dangerous part of this gamble. Life happens. You might develop high blood pressure. Your cholesterol might creep up. You could get diagnosed with sleep apnea or diabetes. Any one of these common conditions can dramatically increase your premiums or, in some cases, make you completely uninsurable. The door to affordable coverage can slam shut forever without any warning. Getting life insurance when you're young and healthy isn't about planning for your death tomorrow. It's about locking in your insurability for the future, guaranteeing that your family is protected no matter what health challenges life throws your way down the road. It's an act of foresight. And here's something most people never consider. Many modern life insurance policies aren't just about dying. They come with what are called living benefits. These are riders, often included at no extra cost, that allow you to access a portion of your own death benefit while you are still alive if you suffer a qualifying critical, chronic, or terminal illness. Think about that. You get diagnosed with cancer, have a major heart attack, or suffer a stroke. While you're fighting to recover, your life insurance policy could advance you $50,000, $100,000, or $200,000 tax-free to use however you want. To pay for medical bills your health insurance won't cover. To replace your income so you can focus on getting better instead of rushing back to work. To give your family breathing room. This transforms life insurance from a "what if I die" product to a "what if I get sick" safety net. And for a young person, This adds a layer of financial security that is simply invaluable. So if you're young and healthy, that's not a reason to wait. It's the absolute best reason to act right now. This brings us directly to the second, and arguably the most insidious myth, because it preys on a false sense of security. Myth number 2. I have life insurance through my job, so I'm covered. This is one of the most dangerous financial traps for American families. Relying solely on your employer's group life insurance is like building your family's financial fortress on rented land. It feels secure, right up until the moment the landlord decides to sell the property. Let's break down why this is such a huge risk. First, and most importantly, it's not portable. That means you don't own it. Your employer does. The moment your employment ends, whether you quit for a better opportunity, you get laid off, or you retire, that coverage evaporates. It doesn't come with you. Think back to our engineer at the beginning. He was covered one day and completely exposed the next. Now, what if when you leave that job, your health has changed? What if you've developed that heart condition or been diagnosed with an illness? You're now in the open market trying to get a personal policy, but you're older and less healthy. The affordable coverage you could have secured years ago is now gone forever. You're trapped. Second, the coverage amount is almost always tragically inadequate. Most employer plans offer a benefit that is 1 or maybe 2 times your annual salary. Sounds nice, a free benefit. But let's do the math. Let's say you make $80,000 a year, and you have a one-time salary benefit. If you pass away, your family receives a check for $80,000. Now, think about your family's expenses. The mortgage or rent, car payments, utilities, groceries, childcare, future college tuition. How long will that $80,000 last? A year? Maybe a year and a half if they're extremely frugal? And then what? The financial rule of thumb recommended by most experts is that you need coverage equal to 10 to 12 times your annual income to truly replace your financial contribution to the family. So in this case, you wouldn't need $80,000, you would need $800,000 to $1 million. Your work policy isn't a solution. It's a small temporary patch on a massive financial wound. It gives you just enough coverage to make you think you're safe, which prevents you from getting the real protection you actually need. Third, you have zero control. Your employer can change the provider, reduce the coverage amount, or even eliminate the benefit entirely during the next open enrollment period to cut costs. You get an email one day and poof, your family's safety net just got smaller, and you had absolutely no say in the matter. When you own your own policy, it's a private contract between you and the insurance company. No one can change the terms, raise your premiums, or reduce your benefit. It's yours. It's locked in. Relying on work insurance is a gamble. It's gambling that you'll stay with that company forever. It's gambling that you'll remain perfectly healthy. It's gambling that your employer will never change their benefits package. That is a trifecta of terrible bets to make with your family's future. The smart way to view work insurance is to see it for what it is. A nice little bonus, a cherry on top. But it should never ever be the cake itself. The foundation of your family's protection must be a personal policy that you own and control, one that will follow you no matter where your career takes you. These first 2 myths are the primary reasons so many families are left vulnerable. But the next myth is the one that stops people who know they need coverage from ever actually taking action. It's the belief that it's simply out of reach, which is the myth that life insurance is just too expensive for the average American family. This idea is so pervasive, it's practically an accepted truth. We see commercials for million-dollar policies, we hear about complex estate planning, and our brains immediately file it under luxury item, right next to yachts and private jets. We think, I'm just trying to cover my mortgage and groceries, I can't afford another car payment. And that's the mental image most people have, a bill the size of a car payment. Let's talk about a guy named David. David is 34, married, with a 6-year-old daughter and another baby on the way. He's a good dad, works hard as an IT project manager. His wife, Emily, is a part-time graphic designer. They do okay. They have a mortgage on a modest 3-bedroom house in the suburbs, they have 2 car payments, and they're staring down the barrel of rising daycare costs. Every time the topic of life insurance comes up, usually late at night after they've paid the bills, David gets this tight feeling in his chest. He pictures a bill for $200 or $300 a month, and he thinks, where is that supposed to come from? The grocery budget? The gas money? He tells Emily, honey, we'll get to it when things are a little more stable. Maybe after my next raise. But more stable never seems to arrive, does it? There's always another expense. The water heater breaks. The car needs new tires. His daughter needs braces. So he puts it off. Not because he's irresponsible, but because he genuinely believes he is making the responsible choice for his family's current budget. He is protecting their finances today, unaware that he's leaving their entire future exposed. David's assumption is the same one millions of Americans make. And it's based on a massive misunderstanding. A study by the research group LIMRA found that more than half of Americans overestimate the cost of term life insurance. And they don't just miss by a little. Millennials, for example, overestimated the cost by more than 5 times the actual amount. They guessed a standard policy would cost over $1,000 a year, when the real figure was closer to $200. Think about that. People are opting out of protecting their families based on a price that exists only in their imagination. The reality is, for most people, term life insurance is shockingly affordable. Let's break it down. The single biggest factor in your cost is your age and your health at the time you apply. The younger and healthier you are, the cheaper it is. That's it. The insurance company is just playing the odds. A healthy 30-year-old is a much lower risk than a 60-year-old with health problems. This is why financial advisors practically scream from the rooftops to get coverage when you're young. You're not just getting protection. You are locking in a ridiculously low rate for decades. For someone like David, a healthy, non-smoking 34-year-old, a 20-year, $500,000 term life insurance policy would likely cost him somewhere between $25 and $40 a month. Let me say that again. $500,000 of protection for his family, for less than the cost of a weekly pizza night. It's less than most people's cell phone bills. It's less than the combined cost of Netflix, Hulu, and Spotify. When David finally sat down and got an actual quote, he stared at the screen in disbelief. He felt foolish. All those years of stress, all those delayed conversations, all that risk he put his family in, was over a number that was less than what he spent on coffee each month. The key here is understanding the type of insurance we're talking about. The affordable option that fits 95% of American families is called term life insurance. The name says it all. You buy it for a specific term, usually 10, 20, or 30 years. If you pass away during that term, your family gets the full tax-free payout. If you don't, the policy expires. It's pure, simple, inexpensive protection. It's designed to cover you during your most vulnerable years. When your kids are young, your mortgage is high, and your savings are still growing. It's like renting an apartment. You pay a small amount for the right to live there, but you don't build any equity. The more expensive option you hear about is permanent life insurance, with whole life being the most common type. This kind of policy is designed to last your entire life, and it includes a savings component called cash value that grows over time. It's more like buying a house. Your payments are higher, but you're building equity, the cash value, which you can borrow against or use later in life. Now, permanent life insurance can be a powerful financial tool for specific situations, like high net worth individuals planning their estate or business owners funding a succession plan. But for the average family like David and Emily, who just need to make sure the mortgage gets paid and the kids can go to college if the unthinkable happens, it's often expensive overkill. It's like buying a Ferrari to go grocery shopping. A reliable Honda will get the job done for a fraction of the cost. The trap is that people hear the Ferrari price tag of permanent insurance and assume that's the only price. They don't even know the Honda exists. So they walk away from the dealership entirely, leaving their family to hitchhike if the worst happens. So let's reframe this. Stop thinking of life insurance as a massive, unaffordable expense. Think about what you already spend $30 a month on. 2 trips to a fast food drive-thru? A single movie ticket with popcorn? A few craft beers? Are any of those things more important than guaranteeing your family can stay in their home if you're not there? Are they more important than ensuring your kids don't have to give up their dreams? When you frame it that way, the cost isn't just manageable. It becomes one of the highest value purchases you will ever make. It is buying peace of mind on an installment plan. The true cost isn't the $30 monthly premium. The true cost is what your family would pay without it. The GoFundMe campaigns, the devastating move away from their home and their friends, the lifetime of financial struggle and what-ifs. Once people like David understand how affordable term life insurance really is, a huge weight is lifted. They see a clear, simple path to protecting their family. They go from feeling helpless to feeling empowered. They get their policy in place and they sleep better at night. But then a new question often pops into their head. A new fear. It's the voice that says, okay, that price is for a healthy person. But what about me? I have high blood pressure. I'm overweight. I had a health scare a few years ago. There's no way they'll approve me. And this leads us to our fourth myth. the one that convinces people they are simply uninsurable. And that single word, uninsurable, is an absolute dream killer. It's a label people put on themselves, a heavy cloak of resignation they wear. They see the ads with the marathon running, kale smoothie drinking super parents and think, that's not me. That will never be me. Let me tell you about a man named Frank. Frank was a 52-year-old contractor from Ohio. He'd spent 30 years of his life hauling drywall, framing houses, and turning blueprints into homes. His hands were calloused, his back ached on cold mornings, and his idea of a balanced diet was a burger in one hand and a light beer in the other. Frank wasn't a bad guy, he was a real guy. He loved his wife, was immensely proud of his 2 kids in college, and had a mortgage that felt more like a permanent family member than a loan. Frank also had a trifecta of classic American health issues: high blood pressure, cholesterol that his doctor described with a rather alarming whistle, and about 40 extra pounds that had settled in for the long haul. A few years back, he'd had a scare chest pains that turned out to be severe acid reflux, but for 72 terrifying hours, he and his wife thought it was the end. After that, the thought of life insurance would creep into his mind late at night. He'd look over at his wife sleeping and the dread would wash over him. If he were gone tomorrow, the business he built would crumble. The debt would transfer from his shoulders to hers. The dream they had of retiring near a lake would evaporate. But then the other voice would kick in. The voice of myth number 4. Frank, it would say, who are you kidding? They're going to take one look at your medical chart and laugh you out of the office. Uninsurable. Denied. Save yourself the humiliation. So he did nothing. For years. Then his friend Dave passed away. Dave was Frank's age, in similar shape, and they'd worked on a dozen job sites together. It was a heart attack, sudden and final. At the funeral, Frank saw the absolute devastation in the eyes of Dave's widow. A week later, he heard she had to start a GoFundMe, just to cover the mortgage for a few months. Dave, just like Frank, had believed he was uninsurable. He had rolled the dice, and his family had lost. That was it. Humiliation be damned. Frank decided he had to try. He owed his wife that much. He went online, his hands sweating, fully expecting the digital equivalent of a door slammed in his face. He filled out a form, answering honestly about his blood pressure medication, his weight, his family history. He clicked submit and braced for impact. He didn't get an instant denied. Instead, he got a call from an agent. And this is where the myth of being uninsurable completely falls apart. Because the life insurance industry isn't a simple yes or no, pass-fail system. It's a system of risk assessment. It's a spectrum. The agent explained to Frank that insurance companies don't just have 2 boxes labeled healthy and unhealthy. They have a whole range of classifications. Think of it like grades in school. The A+ students are the preferred plus applicants. These are the marathon runners with perfect cholesterol. They get the absolute best rates, the lowest premiums. This is the image we all see in the commercials. Then you have the A and A- students, the preferred group. Maybe they have slightly elevated cholesterol, but it's well controlled with diet. They're in great shape. They also get fantastic rates. But then you get to the B students, the standard plus crowd. These are people who are generally healthy, but maybe they're a bit overweight or their parents had some health issues. They're still considered a good risk and get affordable rates. And then there's the C students, the standard risk. This is the average American. Frank was a standard risk. He had high blood pressure, but, and this is the critical part, it was managed with medication. He had high cholesterol, but he was taking a statin for it. The insurance company doesn't see a sick person. They see a person who is actively managing their health conditions. They see predictability. And in the world of insurance, predictable is good. They offered Frank a standard term life policy. It wasn't the cheapest rate on the market, but it was real. And it was affordable. But what if Frank's health was worse? What if his blood pressure wasn't controlled? What if he'd had a more serious health event? Does the door slam shut then? No. That's when you get into what are called table ratings. This is where most of the uninsurable people actually land. Think of it as getting a C-, a D+, or a D. You're still passing the class. A table rating is basically the standard rate plus an extra 25% for each step down the table. So, a Table B rating might be the standard price plus 50%. A Table D rating might be the standard price plus 100%. Yes, it costs more. Of course it does, because the risk is higher. But it is not a denial. It is an offer. It is a company saying, yes, we will cover you. Here is the price. For millions of Americans with manageable chronic conditions like diabetes, sleep apnea, or a history of certain cancers, table ratings make life insurance possible. But let's take it a step further. What if you have a combination of serious health issues, and you truly can't get through the full medical underwriting process? Are you uninsurable then? Still no. This is where you find two other major categories of life insurance. The first is simplified issue. With these policies, there is no medical exam. No nurse comes to your house to draw blood. You simply answer a series of health questions on an application. In the last 2 years, have you been treated for cancer? Have you been diagnosed with HIV? They're looking for knockout conditions. If you can honestly answer no to the big scary questions, you can often be approved within minutes for a policy, typically with a lower coverage amount, say up to $500,000. It costs more than a fully underwritten policy, but the convenience and accessibility are a lifeline for many. And finally, for those who cannot even get through the simplified issue questionnaire, there is the absolute last line of defense, the safety net. It's called guaranteed issue life insurance. And the name says it all. Your acceptance is guaranteed. There are no health questions. There is no medical exam. As long as you are within the specified age range, typically 50 to 85, you cannot be turned down. Now there are major trade-offs. The coverage amounts are much lower, usually topping out around $25,000 or $30,000, enough to cover a funeral, final medical bills, and maybe pay off a credit card. And it's the most expensive type of insurance per dollar of coverage. Most also have something called a graded death benefit, meaning if the insured passes away from natural causes within the first 2 years, the policy only pays back the premiums paid, plus some interest. But after those 2 years, the full death benefit is in force. It's not a solution for replacing a lifetime of income, but for someone who believes they are completely 100% uninsurable, a guaranteed issue policy is proof that they are wrong. It is a way to ensure they do not pass a financial burden onto their loved ones. For Frank, the contractor from Ohio, that standard offer felt like he'd won the lottery. He signed the papers for a 20-year term policy with a $500,000 death benefit. The premium was about the cost of his and his wife's weekly dinner out. When the first policy document arrived in the mail, he didn't just put it in a file cabinet. He sat at the kitchen table, read it through, and for the first time in a decade, the knot of fear in his stomach finally truly untangled. He wasn't uninsurable. He was just average. And there was a plan for average. The peace of mind he bought wasn't just for his wife's future. It was for his own present. But as he looked at the document, a new question started to form, a thought that's shared by millions of perfectly healthy people who buy the exact same type of policy. Okay, he thought, this is great, but it's a 20-year policy.
I'm 52.
God willing, I'll be 72 when this thing expires. What happens then? If I don't die, did I just waste all this money for 20 years? And that, right there, is the fifth and final myth. The big one. The one that makes people view the most popular type of life insurance not as protection but as a bad bet. A bad bet. A gamble where, if you win, you lose everything. And if you lose, you get nothing. It's the ultimate head-scratcher, and it leads directly to myth number 5. Term life insurance is a complete waste of money if you don't die. And let's be honest, on the surface, this one makes perfect sense. It feels viscerally wrong to pay for something for 20 or 30 years and hope you never ever have to use it. It's like buying a lottery ticket where the jackpot is your family's grief. We are wired to seek a return on our investment. We put money in, we expect to get more money out. With term life insurance, you put money in for decades, and if you're lucky enough to live a long, healthy life, you get zero back. The policy expires and the money is gone. Feels like you've been played. But let me ask you a question. Did you waste money on your car insurance last year because you didn't get into a catastrophic multi-car pileup? Are you demanding a refund from your homeowner's insurance company because your house didn't burn to the ground? Of course not. You understand that you weren't paying for a payout. You were paying to transfer risk. You paid a small, predictable amount of money, your premium, to protect yourself from a financially devastating, unpredictable event. You paid for peace of mind. You paid to sleep at night. Life insurance is exactly the same, but the stakes are infinitely higher. It's not about protecting a car or a house. It's about protecting a human life and the entire financial world that depends on it. You aren't making a bet that you're going to die. You're buying a contractual guarantee that if the worst-case scenario happens, your family's world doesn't also collapse financially. Let's make this real. Meet Mark and Sarah. They're 32, have a 3-year-old daughter named Lily, and a son, Ben, on the way. They just bought their first house in a decent school district, the classic American dream. It came with a classic American mortgage. They have car payments, student loan debt, and the ever-rising cost of daycare. Money is tight. Their financial advisor brings up life insurance. He runs the numbers. For Mark, a healthy 32-year-old, a 20-year term policy with a $1 million death benefit is about $50 a month. $50. Sarah sees it instantly. She thinks, okay, $50 a month, and if something happens to Mark, the mortgage is gone. The debts are gone. I can stay in our home. I can afford to raise our kids without having to work 3 jobs. I can breathe. To her, it's the cheapest peace of mind on the planet. But Mark sees it differently. He pulls out his calculator. $50 a month times 12 months. That's $600 a year. Times 20 years, that's $12,000. 12 grand. And if I'm still alive in 20 years, which I plan to be, we get nothing back? That's $12,000 we could have put into a $529 for Lily's college, or invested, or paid down the mortgage faster. It feels like we're just setting money on fire. This is the fundamental conflict. Sarah is buying the what if. Mark is focused on the what is. And for millions of Americans, Mark's logic wins out. They skip the insurance. They roll the dice. But let's play out their story. After a long talk, they decide to get the policy. They cut back on a few streaming services and eating out one less time a month to cover the cost. That $50 just becomes another line item in their budget, and they mostly forget about it. Years go by. Lily graduates from kindergarten. Ben learns to ride a bike. They refinance the mortgage when rates drop. Mark gets a promotion. They take a family vacation to the Grand Canyon. They have arguments about who left the milk out. They have movie nights on the couch. They live their life. All the while, every single month, $50 is automatically withdrawn from their checking account. A silent, invisible financial bodyguard standing watch over their family. Now let's fast forward 20 years. Mark is 52. The term life policy is about to expire. He gets a letter in the mail from the insurance company, and he just stares at it. He's alive. He's healthy. He won the bet, which means he lost $12,000. But then he looks around. Lily is in her second year of college, studying to be a nurse. Ben is a senior in high school, a star on the soccer team, with a scholarship offer on the table. The house, their home, is almost paid off. He and Sarah are planning a trip to Italy for their anniversary. They built a beautiful life. And it hits him. That $12,000 wasn't wasted. It wasn't a bad bet. It was the foundation. It was the price of admission for 2 decades of security. It was the thing that allowed him to take risks at work, to invest for the future, to sleep soundly because he absolutely knew, that no matter what happened to him, Sarah and the kids would be okay. He didn't pay $12,000 for a death benefit. He paid $12,000 to remove the ultimate financial fear from their lives. It was the best 12 grand he ever spent. Now, even after hearing that, I know what some of you are thinking. That's a nice story, but I still hate the idea of getting nothing back. The human brain is funny. That feeling of loss is powerful, even when it's illogical. So what if I told you there's a way to hedge that bet? What if you could get the protection, and if you outlive the policy, you could get every single penny of your premiums back? It sounds like a marketing gimmick, but it's a real product. It's called a return of premium, or ROP, life insurance policy. It works exactly like it sounds. You buy a term policy, say for 20 years. You pay your premiums every month. If you pass away during that term, your family gets the death benefit just like a standard policy. But if you're still alive at the end of the 20 years, the insurance company writes you a check for 100% of the premiums you paid. If you paid in $12,000 over 20 years, you get a $12,000 check. The insurance was effectively free. So why doesn't everyone buy this? Because there is no free lunch. The premiums for an ROP policy are significantly higher than for a standard term policy. We're not talking a few dollars more. We're talking anywhere from 30% to, in some cases, over 200% more expensive depending on your age and health. So that $50 standard policy for Mark might have been $80 or $90 for an ROP policy. The financial argument against ROP is the classic buy term and invest the difference. The theory says you should buy the cheaper standard term policy for $50, and then take the extra $40 you would have spent on the ROP policy and invest it yourself every single month. Over 20 or 30 years, thanks to the power of compound interest, that invested money would almost certainly grow to be worth far more than the total premiums you get back from the ROP policy. From a pure numbers perspective, standard term plus your own investing usually wins. But finance isn't just about numbers. It's about behavior. And the ROP policy is designed to solve a behavioral problem: the feeling that you're wasting money. For some people, the only way they will ever bring themselves to buy the life insurance they desperately need is if they know they'll get their money back at the end. It overcomes that powerful psychological hurdle. If that's what it takes to protect your family, then it might be the right choice for you. Ultimately, whether it's standard term or a return of premium policy, the reframe is the same. You are not wasting money. You are purchasing certainty in an uncertain world. The goal of life insurance isn't to get a payout. The goal is to live a long life and never need it. Outliving your policy isn't a financial loss. It's the ultimate victory. It means you got to be there. You got to see your kids grow up. You got to build a life with your partner. The money you paid was simply the cost of ensuring that dream was protected no matter what. And that feeling, that peace of mind, is priceless. But it brings us to one of the most dangerous and widespread myths of all. It's a myth born out of convenience. A myth whispered in corporate break rooms and reinforced in employee handbooks. It's the myth that says, "I'm good. I have life insurance through my job." On the surface, it sounds responsible. Feels like a box has been checked. Your employer offers a group life insurance plan, maybe for free or for a few dollars a paycheck, and you think, great, one less thing to worry about. But this belief isn't just a myth. It's a financial trapdoor, an illusion of security that can vanish at the worst possible moment. Let me tell you about a guy named David. David was the quintessential company man. For 17 years, he'd climbed the ladder at a respectable manufacturing firm. He was a senior manager, made a great salary, and was universally liked. He had a wife, Sarah, and 2 kids in high school, one just a year away from college applications. David was a planner. He had his 401k, a college savings plan, and he'd made sure to sign up for the company's group life insurance policy. It was for 2 times his salary, which came out to about $300,000. To him, that number felt huge, felt safe. He figured if the unthinkable happened, Sarah would have enough to pay off their remaining mortgage and get the kids through school. He was covered. Then the economy turned. A new CEO came in, tasked with streamlining operations. That's corporate speak for layoffs. And one Tuesday morning, David, the loyal 17-year veteran, was called into an HR meeting and told his position had been eliminated. He was walked to his desk, handed a cardboard box, and escorted out of the building. The shock was immense. The fear was real. But in the chaos of updating his resume and figuring out COBRA for his health insurance, another, more sinister reality was unfolding. Tucked away in his severance paperwork was a single-line item: "Your group life insurance policy will be terminated at the end of this month." Just like that, the $300,000 safety net was gone. Poof, vanished. Now you might be thinking, okay, that's tough, but he can just go by his own policy, right? That's what David thought too. But here's the cruel twist. A few years prior, David had a minor health scare. A bout with high blood pressure, now completely under control with medication. But to an insurance underwriter, he was no longer the perfectly healthy 30-year-old he was when he first joined the company. He was now a 48-year-old, unemployed man with a pre-existing condition on his medical record. When he applied for a new policy, the quotes that came back were staggering. The premiums were maybe 5 times higher than they would have been just a few years earlier. He was facing a choice: pay an enormous monthly bill his family couldn't afford while he was unemployed, or go without protection. The very moment his family was at its most financially vulnerable was the exact moment his coverage disappeared and became impossibly expensive to replace. David's story isn't an anomaly. It happens every single day across America, and it exposes the 3 fundamental flaws of relying solely on your employer's life insurance. First, and most importantly, you do not own it. You are renting it. Your employer owns the master policy, and you are just a participant for as long as you work there. This means they control everything. They can decide to change insurance carriers. They can reduce the death benefit from 2 times your salary to 1 time your salary to save money. They can eliminate the benefit entirely during the next round of budget cuts. You have absolutely no say in the matter. You are borrowing a safety net, and it can be pulled out from under you without your permission. Having your family's entire financial future in the hands of your current employer's HR department is not a plan. It's a gamble. Second, it's not portable. This was David's nightmare. The insurance is tied to your job, not to you. The moment you leave, whether you are laid off, fired, find a better job, or retire, that coverage evaporates. Think about the irony. People often switch jobs to get a better salary and improve their family's financial situation. Yet, in doing so, they often walk away completely unprotected during the gap between leaving the old job and starting the new one. And if you decide to start your own business, that free insurance is gone forever. Your life's biggest risks don't conveniently pause while you're between jobs. True security is a policy that you own, one that follows you wherever you go, no matter who signs your paycheck. Third, the coverage is almost never enough. That 1 or 2 times salary formula is a completely arbitrary number, designed to be a simple, low-cost benefit for the employer. It has zero connection to what your family would actually need. Let's run the numbers. Let's say you make $80,000 a year, and you have a $160,000 policy through work. That sounds like a decent amount of money, but what does it have to do? Let's say you have a $200,000 mortgage, $20,000 in car loans, and $30,000 in student debt. Right there, your entire work policy is gone, and your family is still $100,000 in debt before they've even bought groceries. We haven't even talked about replacing your income. How is your spouse supposed to pay the monthly bills, the property taxes, the utilities, and everything else for the next 10, 15, 20 years without your $80,000 salary? How are they going to pay for college, which can easily cost over $200,000 for 2 kids? When you do the real math, that free $160,000 policy doesn't cover the need for a few years. It might not even cover the debts you have today. It's a band-aid on a bullet wound. It provides a false sense of security that prevents people from getting the real protection they desperately need. Now, some people might say, but my plan has a conversion privilege. This is another piece of fine print that sounds better than it is. A conversion privilege allows you to convert your group term policy into an individual whole life policy when you leave your job, without a medical exam. The catch? The premiums are based on your current age and are almost always astronomically expensive, because the insurance company assumes that only the least healthy people will use this option. It's a last-ditch emergency ripcord, not a viable financial strategy. So what's the answer? It's simple. View the life insurance you get at work as a bonus. A nice little extra. It's the free coffee in the break room. It's the company-branded fleece you get at the holiday party. It's great to have, but you would never ever count on it as the foundation of your family's future. The foundation must be a private, individual policy that you own and control. A policy where you choose the coverage amount based on your family's real needs, your mortgage, your income, your kids' education. A policy where the rates are locked in for 20 or 30 years and can never be changed by an employer. A policy that stays with you if you get a promotion, change careers, or decide to travel the world. You are the chief financial officer of your household. You are the CEO of your family's security. It's your job to protect your shareholders, your spouse, your children. Relying on a temporary, insufficient, and uncontrollable benefit from your employer is like outsourcing your most critical responsibility. True peace of mind doesn't come from a policy that's listed as a line item on a corporate benefit summary. It comes from owning your own protection, from building a fortress around your family that no boss, no layoff, and no career change can ever tear down. And the best time to lay the foundation for that fortress isn't when the storm is already on the horizon. It's now, today, on a calm, sunny day when the threat seems a million miles away. This brings us to one of the most pervasive and, frankly, one of the most dangerous myths I hear, especially from people in their 20s and 30s. It's a myth whispered at backyard barbecues and over brunch, a comforting lie we tell ourselves because it feels so true. And it's this, myth number 3. I'm young and healthy. I don't need life insurance yet. That's something for later, for when I'm older, for when I have kids. On the surface, it makes perfect sense, doesn't it? You feel invincible. You can run a 5K on a Saturday morning, you eat your vegetables, you haven't seen the inside of a doctor's office for anything other than a routine checkup in years. The idea of needing a safety net for the end of your life feels abstract, like planning a trip to a distant planet you might never visit. The problem is, this logic is completely backward. It's like a farmer looking at a field of perfect, fertile soil and saying, you know what? I'll wait to plant my seeds until the drought comes. It fundamentally misunderstands the single most powerful asset you possess right now, your current good health. Let me tell you about 2 brothers, Mark and David. They were close, just 2 years apart. In their late 20s, they were both the picture of health. They played basketball together, went on hiking trips, and were both starting their careers and families. An insurance advisor, a friend of their father's, sat them both down and laid out a plan. He said, "Look, right now you guys are a perfect risk. The insurance companies will be fighting over you. You can lock in a rate for the next 30 years that is ridiculously cheap." Mark, the older brother, listened. He was a planner. He had a wife and a new baby. For about the cost of a few fancy coffees a week, he secured a substantial 30-year term policy, a fortress built on solid ground. David, on the other hand, laughed it off. He said, "Man, I'm 27.
I'm bulletproof.
I've got student loans to pay. I want to save for a down payment on a house. I'll get around to it later." He wasn't being irresponsible, he was just being 27. He was focused on the here and now, and later seemed like an eternity away. For 5 years nothing happened. David was right. He saved that money every month. He put it towards his down payment and eventually bought a beautiful starter home with his girlfriend. He was living the dream. Mark, meanwhile, was just quietly paying his premium, a small automatic deduction he barely even noticed. Then at age 32, David started feeling unusually tired. He chalked it up to stress at his new job and the work he was doing on the house. But it didn't go away. After a few doctor's visits, he got a diagnosis he never saw coming: multiple sclerosis. It was a relapsing remitting form, and thankfully, with modern medicine, his prognosis was good for managing the disease long-term. But his life changed overnight. He was no longer a perfect risk. He was now a young man with a pre-existing chronic condition. A year later, after he and his girlfriend got engaged, the thought of life insurance popped back into his head. He thought, "Okay, now it's time. We're getting married, we have this house, I should do the responsible thing." He called the same advisor. The tone of the conversation was completely different. The applications weren't met with enthusiastic approvals, but with skeptical underwriters, requests for mountains of medical records, and ultimately sky-high premium quotes. The same amount of coverage that Mark got for less than $50 a month was now going to cost David over $400 a month. $400. And that was from the one company willing to offer it to him. Most just flat out declined. His later had arrived, but the price of admission had gone up by 800%. He was trapped. The decision he made when he felt invincible at 27, the choice to wait, ended up costing him, potentially, over $100,000 in extra premiums over the life of the policy. This story isn't about scaring you. It's about showing you the truth. Life insurance isn't something you buy because you think you're going to die tomorrow. You buy it because you're healthy today. Your good health is a coupon. It's a limited time only 90% off coupon for your future financial security. And every single day you wait, you risk that coupon expiring. Think of it like this. When you apply for life insurance, the company is placing a bet. They're betting on your longevity. They look at your age, your health, your family history, your lifestyle, and they calculate the odds. When you're 28, a non-smoker, and in great shape, you are the safest bet on the board. You are the Tom Brady, the Michael Jordan of insurance applicants. They want your business, and they will give you their best possible price to get it, locking it in for decades. When you wait until you're 45, maybe you've put on a few pounds, your blood pressure is a little high, maybe you had a parent with a heart condition, suddenly you're not the star quarterback anymore. You're a riskier bet. And the price reflects that risk. The cruel irony is that the moment you actually feel like you need life insurance is the absolute worst time to buy it. It's when it's most expensive and hardest to get. You don't buy a fire extinguisher when the house is on fire. You buy it when everything is calm and safe, just in case. Your youth and health are not a reason to procrastinate. They are your primary negotiating tool. They are the leverage you have to secure an incredible deal that will protect your family for the rest of your life. And it's not just about major diseases. It's about the little things that accumulate over time. A skiing accident that leaves you with a tricky knee. A diagnosis of sleep apnea. Developing anxiety in a high-stress job. Any of these things can add dollars to your monthly premium. They are the barnacles that attach to the hull of your ship over time, creating drag and making the journey more expensive. By getting a policy when your ship is brand new and clean, you sail through the rest of your life at a fixed, low cost, no matter how many barnacles you pick up along the way. So let's dismantle this myth once and for all. The statement "I'm young and healthy, so I don't need life insurance" is one of the most financially backward sentences you can say. The truth is, because I am young and healthy, now is the single best and cheapest time for me to secure life insurance. It's a strategic financial move. It's not about being morbid. It's about being smart. It's about recognizing the value of an asset, your health, and leveraging it before it diminishes, which for every single human being on Earth, it inevitably will. You are literally at the peak of your powers. You are standing at the bottom of the mountain, and the price of admission has never been cheaper. Waiting to buy life insurance until you're older is like waiting to invest in Apple until after the iPhone came out. You can still do it, but you missed the golden opportunity to get in on the ground floor. The ground floor for your family's protection is right now. It's recognizing that the fortress we talked about isn't built with bricks and mortar, but with foresight. It's built with the decisions you make on quiet, ordinary Tuesdays when the future feels limitless and your health feels guaranteed. Because that guarantee is an illusion, but the low premium you can lock in today is very, very real. With foresight, it's built with the decisions you make on quiet, ordinary Tuesdays when the future feels limitless and your health feels guaranteed. Because that guarantee is an illusion, but the low premium you can lock in today is very, very real. And speaking of real guarantees, let's talk about one of the most dangerous, most widespread, and most deceptively comforting myths of all. It's the one that whispers in your ear at the end of a long workday. You're covered. You're fine. The company's got your back. It's myth number 3. My life insurance through work is enough. Now, I want to be crystal clear. Group life insurance provided by your employer is a fantastic perk. Truly is. It's often free or incredibly cheap, enrollment can be automatic, and it feels like a warm, secure blanket. But here's the brutal truth. That blanket is often too small, made of the thinnest material, and your boss can take it away at any moment, leaving your family out in the cold. Relying solely on your work policy for your family's protection is like building your dream house on a foundation owned by someone else. It looks great, it feels stable, but you never ever hold the deed. The primary reason this myth is so dangerous is because of one simple, devastating word: portability. Or, more accurately, the lack of it. For the vast majority of employer-sponsored life insurance plans, the policy is tied directly to your employment. The moment you leave your job, that insurance vanishes. It doesn't matter if you quit for a better opportunity, if you're laid off during a corporate restructuring, if you get fired, or even if you retire after 40 years of loyal service. The policy dies the day your employment ends. Let me paint a picture for you. Meet Mark. Mark is 45 years old, a dedicated manager at a tech firm for the last 15 years. He has a wife, 2 kids in middle school, and a mortgage. He's a smart guy, responsible. And when it comes to life insurance, he feels secure. His company provides a policy equal to 2 times his salary. That's $200,000. He even buys a little extra, supplemental coverage through the company plan, bringing his total to $300,000. He thinks, I'm set. The company has me covered. Then the economy takes a downturn. The C-suite announces synergistic realignments, which is corporate speak for layoffs. Mark's position is eliminated. He gets a severance package, a handshake, and a box for his desk photos. And in that moment, along with his job, his ID badge, and his parking spot, his $300,000 life insurance policy evaporates. Poof, gone. Now Mark is 45, navigating the stress of finding a new job in a tough market. He knows he needs to replace that life insurance coverage for his family, so he starts shopping for a private policy. But a lot has changed in 15 years. He's no longer a healthy 30-year-old. He's developed high blood pressure. He's put on a few pounds. The premium quotes that come back are 3, maybe 4 times higher than what he would have paid if he'd gotten his own policy back when he was younger and healthier. He's now facing the brutal reality of being priced out of adequate coverage at the exact moment in his life when his family needs it most. His sense of security was an illusion, tethered to a job he no longer has. He didn't own a safety net. He was just borrowing one from his boss. This lack of portability is the knockout punch, but it's not the only problem. The second major issue is that the coverage amount is almost never enough. A typical group policy offers a flat amount, say $50,000, or a multiple of your salary, usually 1 or 2 times. Let's use that $100,000 salary example. A 2x policy is $200,000. To a lot of people, that sounds like a windfall. But let's do the math of real life. Your family would get that check for $200,000. First, they need to bury you, and the average cost of a funeral in the US is now hovering between $7,000 and $10,000. So let's say goodbye to 10 grand right off the top. Now they have $190,000. They have a mortgage payment of say $2,000 a month. That's $24,000 a year. They have car payments, student loans, credit card debt. Let's be conservative and call that another $10,000 a year. Then there's food, utilities, clothes for the kids, car insurance, health insurance deductibles. We're easily looking at $60,000 to $70,000 a year just to maintain their current standard of living, not including any extras. That $190,000? It's not a fortune. It's a runway. And in this scenario, it's a terrifyingly short one. It might replace your income for a little over 2, maybe 3 years if they're incredibly frugal. And then what? What happens in year 4? Does your spouse have to immediately go back to work while grieving? Do they have to sell the house the kids grew up in? What about their college funds? That $200,000 isn't a solution. It's a temporary patch on a catastrophic financial wound. The rule of thumb recommended by most financial experts is 10 to 12 times your annual income. Your work policy isn't even in the same ballpark. It's not even playing the same sport. The third hidden flaw in relying on your work's insurance is the one-size-fits-none nature of group policies. You have virtually no control. The company dictates the terms. You can't customize it with riders that could, for example, pay out if you were diagnosed with a critical illness. You are simply one name on a master policy held by your employer. And because your employer is the policyholder, they can change the terms at any time. They can switch insurance carriers to save a few bucks, which might change the fine print. They can reduce the benefit amount during the next open enrollment period. They can even eliminate the benefit entirely if the company falls on hard times. You have zero say in the matter. A private policy, on the other hand, is a contract between you and the insurance company. You own it. You control it. It's your asset. It's independent of your job, your career path, or your boss's mood. It stays with you whether you climb the corporate ladder, start your own business, or decide to move to a mountain cabin and write a novel. It is your permanent financial foundation. Think of it this way: the life insurance you get from work is like the free coffee in the break room. It's a nice little perk to have while you're there, but you would never ever rely on it as your only source of caffeine for the rest of your life. You have your own high-quality coffee maker at home, right? Your private life insurance policy is your own machine at home. It's the one you can count on every single morning, no matter what. The free stuff at work? That's just a bonus. So, the strategy is not to ignore your work's life insurance. The strategy is to enroll in it, absolutely, especially if it's free, but to see it for what it is: supplemental. A cherry on top. Your plan B, your primary, foundational, unshakable life insurance coverage, needs to be a private policy that you own and control. One that will be there for your family regardless of what the stock market does, what your company's quarterly earnings look like, or who signs your paycheck. Tying your family's entire financial future to the stability of your current job is a gamble. It is a massive, unnecessary risk. You wouldn't let your boss decide who your kid's guardian should be, so why would you let them have the final say on their financial security? Your primary policy should be portable, personal, and dependable. It should be yours. Now, this leads us to another group of people who think they get a pass on this entire conversation, a group that makes a critical and often heartbreaking miscalculation by believing their circumstances exempt them from needing this protection at all. I'm talking about the young, the single, the people with no dependents, the ones who look at their lives and say, "Who would I even be protecting? I don't have a spouse, I don't have kids. This isn't for me." This is myth number 4. Life insurance is only for people with families. And it is one of the most dangerous financial misunderstandings a person can have. To understand why, I want to tell you about a guy named Leo. Leo was 29 years old. He was a freelance graphic designer, incredibly talented, and finally hitting his stride. He lived in a cool, slightly too expensive loft apartment in a city he loved, poured his heart into his work, and spent his weekends hiking with his dog, a goofy golden retriever named Gus. Leo was the definition of independent. He had no wife, no kids, and his parents were retired and living comfortably a few states away. If you asked him about life insurance, he would have laughed. "For who?" he'd say. "Gus? I think he'll be fine." He was young, he was healthy, and his financial responsibilities, he thought, began and ended with himself. He was wrong. What Leo, and so many others like him, failed to see is the invisible web of financial connections that we all have, whether we have a family of our own or not. One Tuesday afternoon, Leo was on his way back from a client meeting. A driver ran a red light. And just like that, Leo was gone. The shockwave of grief that hit his parents and his sister was indescribable. They flew into town heartbroken to do the impossible, to pack up the life of their son and brother. And that is when the second tragedy began to unfold. It started with a call about the funeral. The average cost of a funeral in the United States can easily run between $7,000 and $10,000. Leo's parents, who were living on a fixed retirement income, hadn't planned for this. They pulled the money from their savings, the nest egg they had carefully built to last them the rest of their lives. It was a painful, unexpected blow, but it was only the beginning. As they sorted through his mail, they found a statement for a private student loan. Leo had worked his way through design school, but he'd needed help. The outstanding balance was over $40,000. And there on the paperwork was the cosigner, his father. When Leo was a struggling student, his dad had put his own name on the line to help his son chase a dream. It was an act of love. Now it was a financial anchor. Unlike most federal student loans, which are discharged upon death, private student loans often are not. The lender didn't care about their grief. They cared about the contract. The monthly payments were now his father's full responsibility. Then there was the car. A few years back, Leo's mom needed a more reliable vehicle. Her credit wasn't great at the time, so Leo, who was just starting to build his own good credit, co-signed the loan for her. He was happy to help. But a co-signer isn't just a character reference. They are equally and fully responsible for the entire debt. With Leo gone, the full weight of that 5-year loan, with 4 years left to go, fell squarely on his mother's shoulders. The payments she could barely afford with his help were now impossible for her alone. His parents were now facing nearly $1,000 a month in new unexpected bills for debts that weren't even theirs, all while trying to navigate the worst loss of their lives. They had to sell Leo's car, his professional camera equipment, anything of value just to make ends meet. The process was a slow, agonizing bleed of both money and memories. This is the hidden truth of being unattached. You are never truly unattached. There is always someone who would be impacted. Life insurance for a single person isn't about replacing income for a spouse you don't have. It's about cleaning up the financial footprint you inevitably leave behind. It's an act of profound love and responsibility for the people who raised you, for the siblings who grew up with you, for the friends who stood by you. It ensures that their final memories of you are not tainted by collection calls, mounting bills, and financial panic. It gives them the space to actually grieve. Think about it. A small, affordable term life insurance policy, say $100,000, would have cost Leo maybe $20 a month, less than a few fancy coffees. That $20 a month would have paid for his funeral in full. It would have wiped out the entire private student loan, freeing his father from that burden. It would have paid off his mother's car, giving her one less thing to worry about. It would have covered the costs of breaking his apartment lease and moving his belongings. It would have transformed his parents' experience from one of financial terror, on top of emotional devastation, to one where they could simply mourn their son. And this isn't just about debt. Maybe you don't have debt. Maybe you're one of the lucky ones. But do you have a sibling with young kids? A policy could leave a gift for your niece or nephew's college fund. A final act of love from their favorite uncle or aunt. Do you have a cause you're passionate about? You could name a charity as your beneficiary, leaving a legacy that makes a real difference in the world. Do you have a business partner? A policy can fund a buy-sell agreement, allowing your partner to buy out your share of the business from your estate without having to liquidate the company you both built. Furthermore, getting a policy when you're young and single is the smartest financial move you can make. You are locking in your insurability. You are getting the lowest possible rates you will ever have in your entire life because right now you are at your lowest risk. A policy that costs $20 a month at 29 could cost $80 or $100 a month if you wait until you're 45 and have a health scare. So the myth that life insurance is only for people with families is a fundamental misunderstanding of its purpose. It's not just about protecting dependents. It's about preserving dignity. It's about settling your own affairs so that they don't become the burden of the people you love most. It is the final responsible chapter of a well-managed life. It's a final gift. But even after people understand all of this, they see the value for their aging parents, their spouse, their kids, their business. There is one final myth that stops almost everyone in their tracks. It's the elephant in every room. The number one reason people give for not having the protection they know they need. It's the belief that even a basic safety net is a luxury they simply cannot afford. And this brings us to the final, most powerful myth of all. Myth number 5: life insurance is just too expensive. Let's be honest. This is the big one. This is the showstopper. For millions of Americans, this isn't just a myth. It feels like a cold, hard fact. In a world of rising grocery bills, gas prices that make you wince, and mortgage payments that seem to eat up your entire paycheck. The idea of adding one more monthly bill can feel completely out of the question. It feels like a luxury item you can't afford, something reserved for the wealthy. It's the number one reason people give for not protecting their families. And it is, without a doubt, the most tragic misunderstanding in all of personal finance. Because what if I told you that this belief isn't just a little off? What if I told you that for the majority of people watching this video, your perception of the cost is likely wrong by a factor of 3, or 4, or even more? This isn't just a guess. Study after study confirms it. The insurance research group LIMRA, for example, consistently finds that people dramatically overestimate the cost of a simple term life insurance policy. In one of their landmark studies, they found that more than half of Americans overestimate the cost by at least 3 times. And for millennials and Gen Z, they were even further off, guessing the price to be as much as 5 or 6 times higher than the actual cost. Think about that for a second. It's like thinking a gallon of milk costs $30. If you believe that, you'd never even walk down the dairy aisle. You just assume it's not for you and try to figure out how to live without it. That is exactly what is happening with life insurance across the country. Millions of families are going unprotected because of a phantom price tag that simply doesn't exist. So let's kill this phantom right now. Let's stop dealing in myths and start dealing in real-world numbers. Let's imagine a healthy, non-smoking 30-year-old man. He wants a 20-year term policy with a $500,000 death benefit. That's $500,000, enough to pay off a mortgage, fund his kid's college education, and replace his income for several years. What do you think that costs per month? $100? $200? The average estimate people give is usually over $50 or $60 a month. The reality? For a healthy 30-year-old, a policy like that can cost as little as $25 to $30 a month. Let me say that again. $500,000 of protection for the price of one pizza delivery. Less than your Netflix and Hulu subscriptions combined. You are likely spending more on your morning coffee every week than it would cost to secure your family's entire financial future. Let's try another one. A 40-year-old woman, also a non-smoker in good health. She wants the same $500,000 policy, but for a 30-year term to cover her all the way through retirement. The cost? It might be somewhere in the neighborhood of $45 to $55 a month. Still nowhere near the hundreds of dollars that people imagine. So why is there such a massive disconnect? Why are we also convinced it's a luxury item? There are a couple of key reasons. First, the type of insurance you see advertised is often not the type of insurance most people need. You see ads on TV, often late at night, pushing something called whole life or permanent insurance. These policies are much more expensive because they're not just an insurance policy. They're also a complex investment vehicle with a cash value component. They are a legitimate financial tool for very specific, often high net worth situations, but they are absolutely not the right fit for the average American family just looking for a safety net. What most families need is term life insurance. And the concept is beautifully simple. You buy it for a specific term, 10, 20, or 30 years. If you pass away during that term, your family gets the full tax-free death benefit. If you don't, the policy expires. That's it. There's no complicated investment part. There's no cash value to worry about. It is pure, simple, and incredibly affordable protection. It's the firefighter, not the financial planner. Its only job is to show up with a huge amount of help when the fire is raging. Because it's so simple, it's also incredibly cheap. The second reason for the disconnect is that we lump it in with our other insurance bills. We see our $400 car insurance bill or our $800 health insurance premium, and we just assume life insurance must be in the same ballpark. But it's a completely different product with a completely different risk profile for the insurance company, and therefore a completely different price tag. But the most important shift in thinking we need to make is about the very nature of cost itself. We look at that $30 monthly premium and we see it as an expense, a drain on our budget, but that is the wrong way to frame it. The premium is not the cost. The true cost is what happens if you don't have it. The true cost is your partner having to sell the family home because they can no longer afford the mortgage on a single income. The true cost is your kids having to give up on their dreams of college because the funds you were saving are now needed for groceries and electricity bills. The true cost is your family, already grieving an unimaginable loss, suddenly being buried under an avalanche of financial stress, forced to make devastating choices in their darkest hour. That is the real cost. It's a cost measured in foreclosed homes, shattered dreams, and generational poverty. And when you compare that devastating, life-altering cost to the price of a few cups of coffee a month, the word expensive starts to sound ridiculous. The premium isn't an expense, it's an investment. It's the single most leveraged financial decision you can ever make. You pay a few $100s a year, and in exchange you buy a legally binding contract that guarantees your family hundreds of thousands, or even millions of dollars if the worst should happen. There is no other financial product on earth that offers that kind of return on investment. You are buying peace of mind. You are buying certainty in an uncertain world. You are buying your family the ability to grieve without the added terror of financial ruin. So the question is not, can I afford to pay $30 a month for life insurance? The real question, the one every single person with dependents needs to ask themselves tonight is, can my family afford for me not to? Can they absorb the loss of your income, your contribution, your future earnings, and still be okay? For 99% of us, the honest answer is no. And here's the final piece of the puzzle. You don't have to guess anymore. You don't have to rely on myths or what your neighbor thinks it costs. The only number that matters is your number. Getting a quote is free. It's anonymous. It takes about 5 minutes on any number of websites. You don't have to talk to an agent. You don't have to commit to anything. You owe it to yourself and your family to replace the myth with a fact. To replace the vague, scary assumption of it's too expensive with a concrete, actual number on a screen. Because once you see that number, once you realize that securing a $500,000 promise to your family costs less than your monthly streaming services, the entire equation changes. The fear evaporates, and it's replaced by a feeling of empowerment. You realize that this incredible gift of security, this final act of love, is not a luxury for the rich. It's a fundamental, accessible tool for everyone. It's within your reach. And knowing that, truly understanding that, changes everything. It opens the door to taking that final, crucial step. It moves life insurance from the someday, maybe column to the I need to do this now column. Which brings us to the most important question of all. Now that we've cleared away all the myths, what do you actually do next? So let's build your roadmap. A simple 4-step plan to get you from here to protected. First, let's take a moment to look back at the ground we've covered. We started with the biggest myth of all, that life insurance is too expensive. We shattered that by showing that for a healthy 30-year-old, a significant policy can cost less than your monthly Netflix and Spotify subscriptions combined. Then we tackled the idea that if you're single with no kids, you don't need it. We debunked that by revealing its power to wipe out co-sign debts, cover final expenses, and even leave a powerful legacy for a cause or a family member you care about. We moved on to the dangerously common myth of being covered at work. We exposed that for what it is. A temporary, often insufficient, and non-portable benefit that vanishes the second you leave your job. Then we confronted the ultimate procrastination excuse. I'm too young and healthy. We flipped that on its head, proving that being young and healthy is not a reason to wait, but the single greatest advantage you have to lock in the lowest possible rates for decades. And finally, we dismantled the myth that it's a complicated, painful process, showing how technology has made it faster and easier than ever before. We've cleared the fog. The path is visible. Now it's time to walk it. Step 1 is the most important. Calculate your why. Before you look at a single quote or talk to a single agent, you need to know what you're actually protecting. This isn't about some scary, complex financial formula. It's about your life. Grab a piece of paper or open a new note on your phone. We're going to use a simple framework called DIME. DME. D is for debt. Write down all of your non-mortgage debts. Car loans, student loans, credit card debt, personal loans. Anything that would be left for your family to deal with. I is for income replacement. This is the big one. How many years of your income would your family need to maintain their standard of living if you were gone? A common rule of thumb is 10 years. So, if you make $60,000 a year, you'd write down $600,000. This isn't about making them rich. It's about giving them stability and time to grieve without immediate financial panic. M is for mortgage. If you own a home, write down the remaining balance on your mortgage. Imagine giving your family the gift of a paid-off house. It's one of the most profound and stabilizing things you can do. And E is for education. If you have kids or plan to, what would it cost to send them to college? Look up the average cost for a 4-year degree at a state school. It's a staggering number, but this is a goal you can plan for. Add those 4 numbers up. That's your DIME number. It might look big. It might even be a little intimidating. But don't panic. This is not the price of your policy. This is the goal. This is your why. It's the number that represents a paid-off house, a debt-free life, a college education, and a decade of security for the people you love. Step 2. Know your two basic options. Think of it like housing. You can rent or you can buy. Life insurance is similar. The first option is term life insurance. This is like renting. You buy coverage for a specific period or term, usually 10, 20, or 30 years. If you pass away during that term, your family gets the payout. If you don't, the policy expires. It is simple, straightforward, and incredibly affordable. For over 95% of Americans, term life is the perfect solution. It's designed to cover you during your most vulnerable years, when your kids are young, your mortgage is high, and your income is critical. The second option is whole life insurance. This is like buying a house. It costs significantly more, but it's designed to last your entire life, and it builds up a cash value that you can borrow against. It's a much more complex financial product, often used for very specific estate planning or high net worth scenarios. For the vast majority of people watching this, the message is clear: start with term. Get the most coverage for the lowest cost to protect your family right now. You can always explore other options later. Don't let the complexity of whole life stop you from getting the term coverage you need today. Step 3. Shop smart. The old days of a pushy salesman sitting at your kitchen table are over. Your first stop should be the internet. Use an independent online broker or a comparison website. These platforms are fantastic because they aren't loyal to one company. They work for you. You put in your basic information, and within seconds, you can see quotes from a dozen or more A-rated insurance companies, all competing for your business. This is how you ensure you're not overpaying. You can see right away that Company A might be great for a 30-year-old non-smoker, but Company B offers better rates for a 45-year-old with slightly high blood pressure. The power is in your hands. Step 4. The application. This is the final hurdle, and it's much smaller than you think. You'll fill out an application that asks about your health, your family's health history, and your lifestyle. Do you smoke? Do you have any dangerous hobbies like skydiving? It is critically important to be 100% honest here. Lying on a life insurance application is fraud and can result in the company refusing to pay the claim, which defeats the entire purpose. After the application, many policies require a short medical exam. They'll send a paramedic to your home or office for free, at a time that's convenient for you. They'll check your height and weight, take your blood pressure, and get a small blood and urine sample. The whole thing takes about 30 minutes. But here's the game changer. For many applicants, especially those who are younger and healthier, this step is being waived entirely. It's called accelerated underwriting. The insurance companies use data and algorithms to assess your risk, and you can often get approved for hundreds of thousands or even over $1 million in coverage in a matter of days or sometimes even hours with no medical exam whatsoever. And that's it. That's the entire process. Calculate your why, choose term, shop around online, and complete the application. For steps. You can start the first 3 right now, in the next 15 minutes. What we've been talking about today is so much more than a financial product. It's a promise. It's a plan. It's the ultimate expression of responsibility and love. It's a final letter to your family that says, I've got you. No matter what happens, I've made sure you are going to be okay. Buying life insurance is like planting a tree whose shade you know you will never enjoy. It is a selfless act that provides comfort and protection for generations to come. The monthly premium isn't a bill. It's a deposit into a bank of peace of mind. The real product you are buying is the ability to close your eyes at night, knowing that the financial chaos that so often follows a tragedy will not visit your family. You are building a safety net that protects their future from the biggest, what if? So your task for today isn't to go out and buy a policy. It's simpler. Just take the first step. Take 15 minutes after this video ends. Find an online calculator and run your dime numbers. Get a few anonymous quotes. See for yourself how affordable it is to protect the world you've built. Demystify the process for yourself. Move it from a vague, intimidating concept into a concrete, achievable goal. Because protecting your family's future is the most important financial decision you will ever make. Don't leave it for someday. Make today the day you start.